Hello everyone. Thanks for tuning in to this episode of Zerodha Educate. We have an amazing conversation for you. One of the things that investors struggle the most is with expectations. We all know that mid caps and small caps tend to have higher returns than large caps, but those higher returns come with a cost. This is higher risk or volatility. But investors still chase these funds lured by past returns and redeem them when they inevitably fall. So in this conversation, we caught up with Rahul Singh, the Chief Investment Officer of Equities at Tata Asset Management. In this conversation, Rahul talks about whether the Indian markets are too small for good opportunities and then talks at length about the nature of mid and small caps and how should investors think about them and allocate to them. Please enjoy this conversation with Rahul.
Hello everyone. Today is going to be an interesting podcast with Rahul of Tata AMC. So let's get right into it. How did you go studying from mechanical engineering to the stock market? So tell me about your journey, Rahul sir.
Hi Pratik, good to be here and good to be talking to you. About 30 years ago, 25, 30 years ago, that is what you did when you were in an industrial town and all of your peers wanted to get into engineering. And that is what I did. And I did well in JEE and I ended up in IIT. But I think the foundation which I got in engineering and IIT in terms of how to learn and how to problem solve is what I have carried through and through. I mean, I don't claim to know engineering very well, like a lot of engineers who used to get into engineering at that point of time. But clearly something which gave me a lot of confidence when I went into engineering, and also to interact with peers who were in terms of intellect, sometimes way above you, kind of humbles you. So when you crack an exam and you are a star in your small town from where you got into an IIT, and then you kind of meet other people who are much superior to you in terms of intellect, it kind of humbles you. So these are the two things which have helped me over the years. I would say more than engineering per se. You're right.
Excellent. So I think, so how did you get into the markets, and now you're the CIO at Tata? So how did that actually happen?
So I think post engineering, when I reached the final year, obviously I realized that if there are only two ways to go, either you do further studies in engineering, do a PhD, MS, go to US, which was not really seeming to be my cup of tea. And I was beginning to get interested in business and economy on a very superficial level, but clearly I wanted to do an MBA. It was becoming more and more clear once once I was nearing the end of the engineering college. And so I got into an MBA. I did my MBA 2 years from IIM Lucknow, and that then one thing led to the other. It was very clear that I had a more analytical bent of mind. I did well in courses and in events or competitions which required more analysis and also required more knowledge of finance. And then I kind of graduated. I did my post-graduation from IIM Lucknow, and then I moved into CRISIL, which is India's best and top most rating agency. And believe it or not, I spent my 5 years in CRISIL doing debt markets and doing debt ratings, which are in the limelight now more than equities. So I did on the debt side spend quite a bit of time analyzing companies. And CRISIL at that point of time used to be only 80, 90 strong organization. So it was a small team, very collegial, very, very close knit, and everyone knew everyone else. So it was a great learning ground, because when the organizations are small, you learn a lot, and that kind of made me extremely strong in terms of balance sheet analysis, business analysis, industry analysis. So funnily enough, the the skills which I am now using in equities, most of the background or the, let's say, the foundation was from the debt side and from the debt rating side in CRISIL. And I think that's been the most interesting part of my career. Typically, if you would see equity or equity CIOs or fund managers, you would see them starting as an equity analyst and then moving on to buy side and so on. But my journey has been from the debt side to the equity sell side. So I was covering companies. Then I moved to on the equity brokerage side. I've worked in Citi, Standard Chartered, and covered a lot of sectors, analyzed a lot of companies from an equities perspective before I got into the buy side, which is, when I say buy side, before I got into fund management per se, and moved to Tata's about 2 years back. So it's been a complete journey, having seen the debt side, the equity analysis and hardcore analysis and brokerage side, and then now on to the fund management side. So I can claim to understand a little bit about everything without being a master of one.
Yeah, no, this is interesting. Actually, I realized that fundamentally, when you think of, say, a company selling 4 products, for example, the equity side will think, what if this 4th product does phenomenally well, which is going to be introduced? And the debt side will think, what could go wrong? What if this one product doesn't do well and I don't get my money back? So these are like 2 fundamentally different ways of thinking. And I guess what I understand from your journey is you're able to think on both sides, what can go wrong and what can phenomenally go really well. And I guess that's why your mechanical engineering background of analytical thinking has really helped, perhaps. That's very interesting.
Yeah, exactly. I think, I can think from a debt analyst perspective. I can relate with a lot of the events which have happened in the past 2.5 years since, let's say, the problems which have happened on the debt side in the market, the whole market freezing because of series of events around ILFS and beyond. I could relate to them much quicker. I won't say much better, but much quicker than, say, maybe some other person who's not had the debt experience. And I think that helps. I mean, once in 5 or 10 years, it'll help you, but it helps you connecting the dots very quickly when the time comes.
So my next question is connected to the organization you're with right now. So a lot of our listeners know this. I was born and brought up abroad. I studied abroad. Then when I came to India, someone said, Prateek, if you ever get the opportunity to work with Tatas, then they're associated with trust, and you shouldn't let that opportunity go. You should do business with them. Right? So here's my question to you. So not many investors actually know that there's a Tata mutual fund. We associate the Tata brand with so many things, but a lot of us don't know that there is a Tata mutual fund. So given we have so many AMCs, so many schemes, what makes Tata AMC so special?
Yes, I think there are 2 things I would like to highlight apart from trust, which I don't need to reinforce enough. I think the 2 things are that when you look at our funds, we have a complete suite of products. So we have ranging from large cap to the hybrid category to the small cap, to the thematic funds like digital, pharma, and I think even resources and banking and consumer. So we have the entire gamut of funds, which is very rare for a fund house of our size. I think so. We offer a lot of choice. The other thing which I would like to highlight is, yes, maybe some of the things which you're saying is correct, and it's nothing to do with not much to do with performance or intention, but more to do with the fact that we want to do our job, keep a medium to low profile, and do it well, and do it consistently. And since the time I have joined, we have actually streamlined a lot of processes also, and also defined our positioning. So when we invest in equities, what do we really stand for? Because, you would have heard that XYZ is a value investor and XYZ and ABC is a growth investor. And you would wonder, what do these actually mean?
Right.
So I would like to put us in the camp where we call ourselves as growth at reasonable price. So we are not a we are not investors who will go behind growth even if it's crazily priced. You will never find crazily priced stocks in our portfolio, at least not in the top 10. At the same time, we are not value investors. You have a section of the market which buys cheap stocks, value stocks, and wait for 3, 4, 5 years for the value to emerge. We are not that patient either. We want to buy a growth at a reasonable price, which essentially defines us. And I think I would like to spend a little bit of time here because of the fact that I think investors should know what does growth at reasonable price mean. It means 2-3 things. One is when we buy value stocks which have catalysts and which can deliver meaningful upside over the next 6 to 12 months. We don't want to buy value for the sake of value. Similarly, when we look at growth, we look at growth from the lens of how can there be a positive surprise. So if the market is already assuming growth, there is no fun. Ultimately, in equity investing, you have to beat the market. And the way to beat the market is to try and predict based on your analysis whether the expectations from a company, whether let's say any company in IT services or software or pharma, can those expectations be beaten? Are those expectations going to be beaten so strongly that you will make extra returns? Because in equities, you make additional return or you make good returns when two things happen together. When that the companies beat earnings, and second, the valuation re-rating also happens simultaneously. Something which is happening in say IT or pharma sector today.
Right.
Are ideal kind of examples of that. So that defines us. I think when we try and identify which companies or sectors are going to surprise, and mind you, post-COVID, there have been a lot of changes. There have been a lot of opportunities which have come our way, and we have made those made good of those changes, which is entirely counting on this logic. If you were counting on one of the two, which is just buying value for the sake of value or buying growth for the sake of growth, you would have struggled in the last 6 to 7 months. Our strategy actually is more discerning in terms of what value you want to buy or what kind of growth you want to buy. And I think that is what we stand for. We obviously, across the funds, we manage using these philosophies. And I think, I think we've done fairly well. We are getting a lot of consistency in our performance. We need to do more. As I said, I think we need to be humble. And there's something which I mentioned in the beginning, that what the market teaches you is to be humble and not take things for granted. And our philosophy actually is exactly that. So we don't want to take things for granted in a high growth, very expensive stock and assume that it will always deliver. That is never the case. We have seen so many cycles. We've seen so many companies delivering high growth for 5 years, and the next 5 years can turn out to be very, very, very slow and very nasty. Because when you go into the reverse cycle, when growth doesn't meet expectations, you have valuation derating as well as you have, earning disappointments. So we need to be more disciplined. I think that is the word I would want to use apart from trust when you think about our funds.
Perfect. I'm going to ask you a question which is you probably not going to like, but I have to ask because this is on people's minds. You talked about, I'll just summarize what you just said, right? So you talked about the value cycle, where Tata is not, where, people may wait. You said 5-6 years, it could be even 10 years actually for some value to get unlocked or more. Then there is growth where, you have hyper growth and you're somewhere in the middle. And then you have earnings expectations. Can the market beat what our expectations are? Now, the last year, the last 6-7 months, have been so crazy. We've seen a bull market, then we've seen panic. We've also seen then people going into a buying frenzy and then markets going up, right? So you had a little bit of value investors coming in, you had some growth investors coming in, all types of people entered because we saw 3 different kinds of markets in a really short period of time. So what is going to happen over the next 1 year? What should be the mindset of an investor?
A good question, and I don't claim to know the answer from a 1 year perspective completely, but I'll give you some guiding points which we are using internally. So, look, I think it is becoming more and more clear that we will live with the virus. We will have to have our lives going on, coming back gradually. And in September, October, we have actually seen life coming back more than gradually and very, very strongly if you look at the indicators which are showing that. So, I think the market is completely changed. What we had 8 months back versus what we have now, completely changed. So I think there are a lot of tailwinds, something which I call as business thermals. This is a word which I've borrowed from the natural thermals which eagles use to glide in the air. Similarly, we have business thermals which are now emerging out of COVID, and there are some 3 or 4 key trends. Obviously, digital is one. Outsourcing, moving from China to India is another one. So I think instead of worrying about market or index level, ki index ye ho jayega, and you will have how much return you expect from index level, it is meaningless beyond a point. It is really fruitless because we might have a 5% index upside from here for 1 year, but you will have certain sectors and certain themes like with what I mentioned about digital transformation or pharma or chemicals or even electronic manufacturing. These are 3-4 things which are catching on big time, and I think they will do well irrespective of where index goes. I mean, index might be flat for all I care, or maybe 5% up in 1 year's time. But if you are in the right sectors and right stocks in those sectors, you will get your 15-20% return in those sectors. And on an aggregate basis, our objective is when we ask investors to invest in equity funds, our objective is over the next 3 years or 2 years to deliver an annualized return of anywhere between 11 to 13%. Now, why 11 to 13% and why not 15 or why not 8%? The reason is simple. We are now in a situation where your fixed deposits are not earning you much, your liquid funds are not earning you much, your AAA bond funds are not earning you more than 5.5%. So across the investing sample, the return profile has come down, and so will the return profile in equities come down. If you look at India's GDP growth rate after all this is through, maybe we'll grow at 6% next year. Add inflation of 3%, so we'll grow at 9% next year, let's say. So on a 9% nominal GDP growth rate, assuming that I do a better job of selecting stocks and selecting companies which are growing faster. So even if I have 25% of my portfolio or 30% of my portfolio which can deliver 20-25% return, and the rest of them deliver 9% return, which is in line with the GDP growth rate, I get to a 12-13% kind of a number. So that's a very simple math. Ultimately, we have to keep it simple and put a certain framework in the mind of investors as to how much return one should expect from equities. This is not to say in the next 1 year you cannot get say only 10% or you cannot get, let's say, 20%. I think it's both the possibilities are always alive in equities, and therefore one has to look at from a 2 to 3 year perspective how much can one earn from equities on an annualized basis, and that is what I think those are the numbers one should keep in mind. And when I mentioned 11 to 13%, that is the kind of expectation one should have from say a diversified mutual fund investing in multi-cap across all market cap categories. I mean, you could have one sector doing very well, but if you're investing in a multi-cap fund where you have equal representation of, say, large cap, mid cap, or small cap, or at least representation is in line with the market, those are the kind of returns you should expect.
Right. I think the expectation is I think the first thing investors should know is expectation. And unfortunately, all investors look at either rolling returns or the past CAGR or last year's returns to decide. So I had to ask you that. So people should reduce their expectations. It just feels, I have no data on this, Rahul, but it just feels like a lot of people have either entered the market for the first time after the lockdown, or they're about to enter. So I think the first thing they should think about is, what should be my expectation? And ideally it should be low and a long term. So that makes perfect sense. But one thing I wanted to ask you about India specifically, right? India has some 200 to 300 stocks where you have most of the liquidity, right? Where most trading is happening, where the bid-ask spread is actually tight, and when you can actually invest, right? Beyond that, you don't have liquidity, you don't have brand, you don't have large companies. So do you think the opportunity set in itself in India is limited? Also, given we have 40 AMC. So that's the first question. And the follow-up to that is, should investors think about an international diversification as well? I know you at Tata don't have an international fund yet. Maybe there's some plan to do that. So tell me about the opportunity set in India. Beyond 200, 300 stocks, there's no liquidity. And second, should investors look at international funds for diversification?
Yeah, we have plans too, but we'll talk about it when we get there in a few months. But I think in India, what we see is that we have the large caps, which are obviously evergreen, all-weather stocks. Then you have the mid and small category, in which the interest comes once in 3 years and then it dies down. I think in small cap and mid cap, where you're right, the liquidity is not there, and therefore when you get to a year when everything is going right for small caps and you see returns, more money comes in, unfortunately at the time after small caps have gone up 50-60%, and that is the sad part. I think in small cap you should have a systematic way of investing. I think there are a lot of opportunities. I would tend to disagree with you. I think the reason why people think there are not enough opportunities or not good companies is because they've had bad experience with the small cap sector. But if you look at the themes which I mentioned, which is, let's say, manufacturing moving from China to India, we all know that it is there for everyone to see. It is a worldwide trend. It is not just a trend for India. If you look at things like pharma or API pharma or pharma raw materials, if you look at chemicals, if you look at electronic manufacturing, how much we import from China and how much can be replaced. And if you look at manufacturing in general, where China has been such a big force that if world starts to reduce its demand from China, Indian manufacturing will benefit. And the reason I'm mentioning these sectors is these sectors are not so much represented in large caps, but they are more present in mid and small cap. In large cap, you will not see these kind of companies. And therefore, I think over the next 5 years, you will see mid and small cap doing equally well. The right way to invest is gradually, and also to be aware that in a year when you start seeing small cap returning 50, 60, 70% on let's say a small cap fund, you need to be taking money out and booking profits. It's as simple as that. In small caps, you cannot assume things for granted, because what happens is when the economy is doing well, when the sector is doing well, things get a little excessive and overheated. So you go from one extreme to the other extreme. Right now, we have spent 2 years in one extreme, and we are only now gradually moving from that bottom end of the extreme more towards the parity. When we start to see a full swing to the other extreme, that is the time you need to be careful about small caps, and not now. This is the time actually where we are seeing opportunities, we are finding opportunities, we are seeing new themes. We are therefore not very hung upon that we should be buying only large caps. We are buying mid and small cap in equal proportion. In fact, in the last 9 months, if you look at our funds, and we did this analysis across the board in all our funds, mid and small cap proportion has actually gone up, even during COVID. So the point I'm trying to make is some of the new themes, when world changes after an event like COVID, you have a lot of new opportunities which open up. and some of those opportunities are more present in mid and small.
So makes sense. So you talked a lot about sector-wise. So let's talk about mid caps a little bit. You guys have been writing about this a lot, large cap versus mid cap debate, right? And in one of your newsletters, and I've written this down, so I'll read it. I'm quoting. Mid caps can be fleet-footed and thus equally capable of developing six-pack abs versus large caps. Meaning the mid cap is the chota beam over here, right? So a lot of people and AMCs have been saying that mid caps look attractive. So what's the deal here? Like they've been correcting since 2018. Now there's a bounce back. What's happening and why is it happening?
So I think, there are 2-3 things at work. Obviously, some of the themes which I mentioned are better represented or better found in mid and small caps. Mm-hmm. And I'm talking about here, I'm going to be talking about mid and small caps interchangeably because in my mind, although SEBI has their definitions, when we are talking in these terms, I think we should be talking in more fungible terms. Okay. So that's number one. Number two is that, if you look at the valuations today at the index level, one can argue that a lot of sectors are pricing in a recovery already. Mm-hmm. We have seen decent recovery in autos. We've seen decent recovery in some of the industrials. We've seen decent recovery in consumer. We have seen obviously very good recovery in IT and pharma, but that's also because the companies have delivered on the earnings already. So across the board, if you look at barring financials, we have seen very good recovery, and most of the large cap sectors are now pricing in a recovery in the next 12 months or fiscal 22. But if I look at the mid and small cap valuations, yes, some of them have started to price in now in the last month or so, but still, if you compare what they have gone through in the last 2 to 3 years of underperformance versus large caps, we are barely achieving parity in terms of, the valuation differential. And therefore, my own sense is that with the new themes emerging, with some of the regulation changes which SEBI is also proposing on multi-cap, and with the fact that we are getting more ideas and more liquidity and more inflows in mid and small cap fund, I think all of that is pointing towards a much healthier next 1 or 2 years as compared to the last 2 years which we have seen for mid and small.
Perfect. Excellent. So you say that mid caps and small caps are interchangeable. So let's talk about both of them, as you say, like fungible, right? So we see investors driven by greed, right? They love small caps. So they think, okay, small caps, choti company hai, small price, it'll double, triple very easily. And a lot of people get burnt in it, right? Because you see crazy volatility in terms of percentage. It may move a rupee here and there, but in percentage terms, it's a lot. And retail investors don't realize that until they're investing on their own. Of course, when they're investing through a mutual fund, things are diversified and it's properly balanced, etc. So how should people allocate to small caps, mid caps, if they're taking the mutual fund route?
Okay, so I think the ideal way to do it is through a multi-cap fund.
Okay.
Multi-cap fund, will have, say, anywhere between 10 to 20% small cap and another 10 to 20% in mid cap. At least that's the case for us. And with the new norms of SEBI, they might have to have 40-50% in mid and small cap. So there will be an adequate representation. So it'll give you a good stability also through large caps. At the same time, it'll give you growth through mid and small. So that's the ideal segment in my mind. If the risk appetite of the investor is high, then maybe 5 to 10% of his investments can be directly in a small cap fund. I think today that kind of investment can be committed in a staggered manner, say an STP or SIP route over the next 6 to 9 months, because we are, as I said, we are far away from the peak which we saw in 2017. We are at the other extreme of valuations, probably a little bit above that, but still very much in the attractive zone. And my advice would be in the year in which a small cap fund gives 50% NAV returns in the last 12 months, that is the year when you start booking profits in small cap. So you cannot, one should not take a very, very long-term approach, because what happens in small caps is there are excesses in between.
Right.
There will be an excess in between. There will be, a phase of euphoria. Those are the times when you need to be a little bit more disciplined.
Okay, so this is a more technical question for me on the fund management side, Rahul. I don't have the answer to this, but when I first read about SEBI saying that in the new category, multi-caps, like you also said, 40-50% may be allocated to mid and small, right? Now that's a decent amount. So if someone's running a very large multi-cap portfolio and he has to allocate like almost half of his money to mid and small, isn't that a liquidity issue if the markets move in one area and there's a lot of redemptions? How does a mutual fund actually manage such a scenario on the fund management side?
No, you're very right. I think it's a big challenge for some of the very large multi-cap funds. I think you have to be in a mid-size multi-cap fund, because these regulations will mean that either those large multi-cap funds have to change their classification, which means they will have to change themselves to large cap or merge themselves with a large cap fund, because you cannot cope up with that kind of small cap buying which is required. And some of these large multi-cap funds have also got very small weightage in small cap as of now. For us, talking about us in general, so our multi-cap fund is about 1,700 crores, which is probably the right size for us to manage this change and still not be impacted. We don't have an issue there. So you have to find multi-cap funds which are medium size, not very small, but medium size, which is 1,000 to 2,000 crores, because they can manage this transition very well. And I think that's the sweet spot really, because you can also, given that you mentioned about liquidity, that liquidity is very low in some of these small cap segments. If you have a smaller fund or a mid-size fund, you are able to take or buy stocks even if they are illiquid, because for your size, they are still liquid enough. Mm-hmm. Whereas for a size which is 5 times bigger or 10 times bigger, it might be a good idea, but they will not be able to capitalize as much as we would be able to capitalize if you are a mid and small cap, if you are a mid and small size multi-cap fund. So that's going to be an advantage when the regulations change, as and when the regulations change, because SEBI is also going through another round of consultation on that. Right. It will be an advantage for the mid-size funds, mid-size multi-cap funds like us.
Okay, a little more on the small cap specific, right? So if we take mid cap out, there have been a lot of studies in India and globally which say that the small cap premium doesn't exist, meaning the amount of risk you're taking, you aren't getting compensated proportionally to the potential reward. Now, Rahul, there can be two ways to look at this, right? So if you're looking at this through the lens of long-term large cap stock investing, where you're trying to see CAGRs over 20 years, 10 years, 7 years, your lens maybe in small cap should be different, because I think a few minutes ago you said that small caps tend to move from one extreme to the other, and they don't move like in a straight line, so to speak, over the long term, like a large cap or say an index would. So is it that these studies have been seeing small caps from the wrong lens? You said that once you reach an extreme, you should probably start booking profits, and there's probably more active management than passive in small caps. So can you just try to explain how should someone look at small caps like this?
Okay, small caps are, like you mentioned, I think, and like I was referring to earlier, what happens in small cap is that liquidity plays a big role, right? And when the liquidity gets sucked out of the market and everything is going to large cap, you have a double whammy in small cap. So fundamentally, they may not be doing well because the economy is not doing well and so on. But on top of it, you have a liquidity. So it's a double whammy. And therefore, the stocks get hit harder in small caps than say large cap, which is what happened in the last 2 years, frankly. The reverse of it happens when there is ample liquidity. Fundamentally, the small caps are doing well. And because the impact of the liquidity on the stock prices is much higher in small cap than large cap. So even an incremental buying will increase the valuations for small cap much faster than for large cap. The reverse of that happens. Okay. So you have two layers. One is the fundamentals. Fundamentals obviously do well. That is the first starting point for any company or any segment to do well. But on top of it, when liquidity plays this role, you have to be a little careful about small caps more than large caps. Large caps will have obviously a slightly more linear trajectory, like you mentioned. But I think in small caps, you will have more violent swings. Right. You will probably end up making decent returns, slightly higher returns than large caps over, say, 10-year period, but you'll have much more violent swings because of the liquidity angle. And therefore, when you get to a position where everyone is talking about small caps, even your neighbor is telling you tips. I mean, even when people start telling me, well, I'm supposed to be the fund manager and I start getting tips to buy this or that, that is the time you have to bolt. That is the time you have to book profits. And typically the other parameter which I use and I always tell investors is when in the last 12-month period you see that your small cap NAV or small cap index has gone up 50 to 70%, that's a warning signal. That's a clear warning signal that things are getting a little out of hand.
I like that.
So these two warning signals one should use to book gains in small cap. And it happens, it happens always. It will happen with regularity every 3 to 5 years. It happened in 2017. We have already completed 3 years. Correct. Maybe in the next 2 years, you will get this wave again.
So the wave this time would be upwards, right? I guess, because these 3 years.
Yes. That's what I meant. Because I think things are falling in place and there are themes emerging post-COVID, which are, in my view, as beneficial to small cap as they have been to large cap. And while large cap is already pricing in a recovery, small caps are yet very, very reluctantly pricing in that.
Right. Yeah, that makes sense. I think this is the problem, right? I think if you're an individual investor, you either give it to a money manager, have a great advisor, or if you're doing it yourself in small caps, if you choose to, then you should have like nerves of steel and a plan that you will not waver from, which is really difficult to do because emotions will take over. And it's so easy to buy and sell stocks now with a tap and a login. It just makes holding on to a plan so much more difficult, right?
That's true. That is true. The discipline is the key, actually.
Excellent. I think this was interesting. Why don't we talk a little bit about you now, Rahul?
Sure.
So personally, tell me, what is your personal investing philosophy and how do you personally invest? What do you invest in?
So, we obviously have a lot of restrictions when we are managing public money. So it's much lesser. So my investments are also through mutual funds only, mostly. And I follow the same philosophy. My own personal investment philosophy when I was doing it more actively personally was also very same, exactly the same which I told you. And to that extent, how I manage the funds is no different from how I used to, manage my own money when I had lesser restrictions. So I think the philosophy has been to buy companies which are not obscenely priced, buy companies where I see that there is something happening in the company, either in the management or the industry strategy change, which can help a company deliver higher than expected earnings. I mean, that is the key. That is the key to me. And then continue holding on to that till the time you see that market is also come at par with you in terms of their expectations. I think that's been my core philosophy, and it has worked well for me. First when I was investing, and now when I'm investing through my funds, and in my funds, and also for the team as a whole. That is the philosophy which kind of is at the core of all our fund managers as well.
Excellent. And if you look back, can you give me maybe 2 or 3 investing lessons very briefly that you've learned over your career?
Yes, I think the investing lessons are more to do with mistakes rather than rather than the winners, because winners everyone wants to talk about and everyone talks about how much money they've made in multi-baggers, which everyone has a share of. But I think the mistakes have been mostly in terms of assessing the let's say the management quality or the strategy going wrong, or basically underestimating the industry trends which change. But when you underestimate, that is when you go wrong completely. And my philosophy therefore has been to, while not do a knee jerk reaction, but clearly stay very very alert and humble in terms of not holding on to any opinions very strongly. Sometimes fund managers and investors fall in love with the stock because it has done so well for them,
Right.
fall in love with the company, their managements, and so on. I think that's the biggest mistake, and that's the biggest lesson one can learn. Not to fall in love with, you're not marrying a stock. You're buying it because you like it, the business. It may continue for 5 years, it may continue for 3 years, but it never ever continues forever. I think that's there are very, very few stocks which you can count in your fingers where, the love will continue for 10 years or 15 years or 20 years. Otherwise, one will always have to be a little bit more humble and be prepared to accept the fact that the company or the sector which you liked once may not be the same sector now, and, things change.
Right. And what are some of your investing books? Do you still read investing books, or what are some classics that you love?
I am not a big reader of books, but clearly something which as a book has, just one sec. Can you ask that question again? Because there was some.
Yes, absolutely. So what are some of your favorite investing books?
I think the book which I've liked the most, although I'm not a big reader of books and I don't get too much time now anyway, but one of the books I really appreciated was Taleb's Fooled by Randomness. I think it's a book which summarizes some of the things which I said, because equity markets have a tendency to make heroes out of normal people, normal investors, and therefore people get a following and they become heroes in terms of their ability to generate returns. I think Fooled by Randomness is basically a message to all the investors to stay humble, to be ready to accept mistakes, and to be ready to accept that you made a mistake. I think is the biggest kind of learning which I took from that book. It's a lovely book. I think it's better than the book, his book Black Swan, which is more famous, but not for me.
Excellent. So I think if you're listening to this and the weekend is near, you know what books to order. We have the recommendation from Rahul. Thank you so much for your time, Rahul sir. I really enjoyed this, and I hope the listeners also enjoyed it as well.
Thank you, Pradeep, and thank you for listening to me, to all the listeners. Thank you.
Mutual funds are subject to market risks. Read all scheme-related documents carefully. Please consult a financial advisor before making an investment decision.